Hi everyone. Today we're going to be looking at Chapter 11, which is Current Liabilities and Payroll Accounting. Just like before in Chapters 9 and 10, we've already learned a little bit of this, so we're just going to be adding on to some of the things that we learned about previously. We're going to start with looking at what current liabilities are, and we're going to be back to the very basics and look at what are liabilities. So a liability is something where we owe to someone else, right? So we've created some kind of a transaction that we are not paying for at the time or that we're going to pay for in the future. So it's either a past transaction or event. It could be something that you have presently created, or maybe something that you're going to owe in the future, but you're going to set it up as a liability or as a payable to pay sometime in the future. If we break that down a little further, we break it down into current and long-term liabilities. So we had said before that current, when we were looking at receivables, current meant that it was within 1 year, and long-term is after 1 year. So same thing when we're looking at payables. The definition for current and long-term doesn't change. So we're looking at current liabilities. It's going to be liabilities that are due within 1 year or one operating cycle, whichever is longer. Typically we're looking at a calendar year or a fiscal year. And then long-term liabilities are going to be the ones that go over that. Now we have to remember there could always be a current portion of the long-term liabilities that we have to factor in. All right, the other part we're going to talk about, which will be new, is that uncertainty that comes along with liabilities. So we have to figure out who are we supposed to pay, when do we pay them, and how much. So we have to figure out when that liability is incurred, what the answers to those questions are. So if a company has $100 accounts payable for a specific individual that's payable March 15th, the answer is pretty clear. We know exactly who we have to pay, how much, and when. But it's not always that clear. Sometimes we have that unknown part, and we have to figure out what the uncertainty is to be able to describe it and decide how it's going to be classified as a liability. All right, so let's look into the known liabilities. And this is what we've seen before. We've talked about liabilities that we are aware of, that we know about. They're going to be liabilities such as accounts payable, our sales taxes payable, unearned revenues. Remember, unearned is still a liability. We have short-term notes payable, payrolls liability, and multi-period known liabilities. So those are things that we can definitely determine the liability amount. We're going to know exactly what we owe and when we owe it. They're set by either agreements, contracts, or laws, and they're measurable. So let's look at an example of sales tax payable. So it says if Home Depot sold $6,000 that are subject to a 5% sales tax on August 31st, what does our entry look like? All right, well, we're getting $6,000 cash. We have sales of $6,000, but we have a 5% sales tax. We're not paying that right then. We're going to be paying out the sales taxes probably quarterly. So we would be debiting the cash for the total amount, which we have to figure out what that is. We're going to credit sales for the amount of sales, and then we apply that 5% to the amount of sales. So 6,000 times 5% is 300. That's the amount of our sales tax that we're going to be recognizing. So we're going to set it up as a payable until it's time to pay it. But we know about that amount that we're going to pay in the future. The next one is unearned revenues. With unearned revenue, remember, that's when they're paying us up front for a job that we're going to do. So the example they show us here is that Selena Gomez sells $5 million in tickets for 8 concerts on June 30th. So we're receiving the cash up front. So we're debiting cash for $5 million. We're crediting unearned ticket revenue for $5 million. At the end, we see that they perform a concert, and I see an error in their thing. So let me see if I can fix that really quick. Okay, they had a name error in there. So in this example, Selena performs a concert. So it's 1 concert out of the 8 total. So that means we recognized 1/8 of that 5 million. So we take 5 million times 1/8 to recognize that revenue. But when we had set it up, we set up a liability, that unearned ticket revenue. If she had canceled all the concerts, she would owe that back to the purchasers. So it will be a liability until she performs the concert. All right, now we're going to shift into short-term notes payable. So remember, we talked about notes payable before. Now we're going to break it down into short and long-term. So with a short-term notes payable, that's a written promise. Remember, a notes payable typically has a promissory note, and it's often going to include interest and a specific day that it's going to be due. So a short-term notes payable is going to be a written promise to pay a specific amount on a specific date in the future, but it's within 1 year. That's what classifies it as short-term. So we might have switched them over. Maybe they owed us an accounts payable and they didn't pay it, so we made them sign a promissory note. We're going to charge them interest to make them have to pay interest on the balance that they didn't pay before. It could also be when you're borrowing money from a bank. All right, so to give us an example here, it says August 23rd, Brady Company asked McGraw to accept $100 cash and a 60-day, 12%, $500 note to replace its existing $100 accounts payable. So they had accounts payable they didn't pay. They owed a total of $600. They're going to pay $100 cash, and they're going to sign a note for the rest of it. So we're clearing out the accounts payable from McGraw. We're going to clear that out. The $600 accounts payable is gone. They're paying $100 of it. So we're paying cash at $100. So we're crediting cash, and we're creating a new payable, the notes payable of the $500 difference. Now remember, we're going to have to pay interest on top of that. So that's what we're going to see later on. All right. So now it's time. The note is due, and we have to pay for it. So we had the principal amount, that $500 that we have to pay, and then we also have interest. So we have $500 times the 12% interest that we agreed to, times 60 out of 360 days. That's going to give us $10 interest that we would have had to pay. So now it's time to pay it. We're going to debit the notes payable for the principal amount, that $500. We're going to debit interest expense for the amount of interest that they've earned, that we have to pay on the note over the period. And we're going to credit cash for the total amount that we're actually paying out. All right, the next scenario is when we have a note that we signed with the bank. So it's September 30th. A company borrows $2,000 from a bank at 12% interest for 60 days. And we're going to record that liability by debiting cash for the $2,000 that we received and crediting notes payable for the $2,000 that we owe now. When it's time to pay it at the end of that 60 days, just like the one we had the notes payable for that we had switched over from accounts payable, we're going to have interest expense we have to recognize, and that adds to the total cash we're paying out. So we have our principal amount that we're clearing out by debiting notes payable. We have interest expense, where we're going to take the principal, the $2,000, times 12% rate, times 60 over 360. We have $40 of interest that we have to pay. So we're debiting interest expense for $40, and we're crediting cash for $2,040. So the $2,000, that's our face value or our principal value. And the $40 is our interest, and the total amount we're paying is that $2,040. Now, one thing to remember is if we get to the end of the year and we have a note that started maybe in November, but it ends in January, at the end of December 31st, we have to do our adjusting entries, and we would have to recognize any interest that has been incurred since the signing of the note. Just like we've done before when we had interest receivable, we wanted to recognize the interest we would receive. Now we're going to recognize the interest expense we would have as of that date. We would set it up as a liability that we'll pay in the future. So here's an example for that one. So it says on December 16th, 2019, a company borrows $2,000 from a bank at 12% interest for 60 days. An adjusting entry is then needed on December 31st. So we're 15 days into the note, but we're closing out the year. So we have to do an adjustment to show how much interest we've earned. Because remember, we have to follow, we want to recognize interest when it's earned, and we want to make sure that we're following the matching principle that revenue and expenses are incurred in the correct time periods. So for this one, we have $2,000 principal times 12%. Now we only had 15 days, so 15 out of the 360 is what we're incurring now. So we're going to debit interest expense for that $10, and we're going to credit interest payable for that $10. Then when it's time to pay the note, we're going to bring that interest payable forward. So we're going to debit interest payable. That's $10 of the note interest that we've already recognized. And then we have to recognize the additional 45 days. So 2,000 times 12% times 45 divided by 360 gives us $30. So that's the difference in the interest of what we did not recognize as interest expense yet. So we would debit interest expense for the 30, debit interest payable for the 10 that came from December 31st. We're going to debit the principal or face value of the note. And the amount of cash we're paying total is $2,040. So we're going to credit cash for that $2,040. The thing to remember is always making sure that you bring forward what you put into there on December 31st. All right, the next part kind of shifts gears and we go into looking at payroll. So we're going to look at employee side of it, like what we have to record for the employee and what we have to record for the employer. So we'll get into that in the next video. Thank you.